From R.D. Smothers Wealth Management, this is The Retirement.
When you retire, if you want an exciting life, you need a boring investment strategy.
Matters.
If you enter into retirement without a plan for income, you're not retired, you're simply unemployed.
Podcast.
Hey, this is your host, Dale Smothers, and you're listening to the Retirement Matters Podcast. My hope is that you will find the information you need in every single show on how to do one of the three things: either saving more money more efficiently, planning better for your future where you can live in retirement worry-free, or my favorite, how you can live a happy and fulfilled life in this life you have been given. We know that your time is valuable and we appreciate you spending it listening to this episode of the Retirement Matters Podcast. On this episode of the Retirement Matters Podcast, we go into detail on the tax plan at the very end of the show. Now, we talk a little bit about SpaceX. You may have heard about that in the news, and you may even be questioning, should I be buying that particular stock? I'm not here to recommend for or against, per se, any individual stock, but I am here to tell you when I see something that's just significantly overpriced like SpaceX, I've got to call it out. So I don't know when you're listening to this. It could be years in the future. It could be weeks in the future. But I'm going to tell you, SpaceX at nearly 100 times its revenue is very overpriced. So, again, have no idea when you're listening to this, but full disclosure, this episode was first broadcasted on June the 27th of 2026, and at that time, SpaceX was very much overpriced. If you're listening in the far future, maybe you think, well, of course, $150 a share. Man, I would love to have bought it then. But I see a dip coming. And most of the clients we serve, most of our listening audience, perhaps yourself included, would really like to keep from having a stock they purchase be cut in half. And I think that very easily could happen with a name like SpaceX. Now, I'll get off of my recommendation stoop here because I know that's not compliant. But I do want you to be aware things can become overpriced even if they're good companies. That's why it's important to know what you own and then, of course, know how long you plan to own it before you purchase that particular stock. We would be happy to help. If there's anything we talk about in this episode that you would like to talk more about in person, give us a call. We'll be here to assist you with what the next steps look like. So without further ado, let's jump to this week's episode of the Retirement Matters Podcast. Enjoy the show. Good morning to you. I hope you're doing well and you're ready to start discussing all things retirement matters. This weekend show is going to be full of good information, especially if you're over the age of 60 and you are perhaps entering into a period of time that we call your opportunity zone. You really need to be looking into your own tax plan. And we find that many times people do not have one. They may have a tax advisor, and we're all about that. But we're going to discuss today why you need a proactive tax plan to determine whether or not you need to utilize the opportunity zone inside of your tax brackets before you reach the age of 63. Between 60 and 63 is a perfect time for you to begin doing some of these strategies. And we will tell you why that is the case, why doing it too soon may be costly, why doing it too late may be just as costly, if not more so. We're going to get into that later in the show. And if you listen to the show very often, you know that we talk a lot about the 5 worlds of retirement. There are 5 worlds of retirement decision that you will go through. And you will choose to either go through those alone, or you will go through those with advice and help from people who have been there before, and in our case, helped navigate hundreds of people through those situations before. This is where we step in as your retirement planning expert to help you understand why you need to be focusing on things like tax planning. Another one is investment planning. You may think, well, I've already got an investment advisor, I've already got a broker, but does that financial advisor really look at this from a holistic perspective? Are they looking at how your investments will be taxed in retirement? Are they looking at how your investments will generate income and what accounts need to be turned on when? Are they looking at how you will take Social Security and how all of that plays in with your existing investment decisions? Are they helping you navigate Medicare? This is a big decision. This is what we call the healthcare world of decision. Medicare, long-term care, the alphabet soup that comes around Medicare decisions. And you will also need someone to help you with your legacy desires, especially because the legacy portion of this plan is likely going to be carried out without you here. This is what legacy is designed to be. It's what do you want this money to do whenever you have passed away? Someone needs to know how to help you. And our team is here and committed to making sure that your desires, both while you're living and after you have passed away, are carried out. This is our commitment. R.D. Smothers Wealth Management, we're here to help you build plans customized to you. We build 5 roadmaps specifically helping you navigate these 5 worlds of retirement decision. Together, those roadmaps make up your retirement atlas. That is exactly what we build for every one of the clients we partner with. Your retirement atlas. At the end of the show, you're going to get an opportunity to either have a phone call with one of our team members or set up a no-cost consultation in office, either our Campbellsville office or our Bowling Green office. We're going to have an opportunity to really start pointing you in the right direction, and with that, help you know what the next steps need to be, whether that's partnering with our firm or not. Again, no cost, no obligation, just an opportunity to discuss what your next steps should look like. If you're over the age of 59 and a half, now is the time, and I don't want you to miss that opportunity. All right, we're going to go to the pause for positivity this week. And this pause for positivity comes to you simply from a thought that I had as I was walking into the gym a few days ago. I like to have a plan for the gym, and I promise this is not about planning out your workout like you would plan out your retirement. This is a little bit deeper than that. What I was doing on the way in is I was kind of looking for my overall workout, and I like to have it wrote down on what weights I'll use, what workout I'll actually do, how many sets I'll do, how many reps I'll do. All of that is really to help keep me on track. Because if I'm not careful, I'll be guilty of checking an email or checking a text message or watching a YouTube video or listening to a podcast, and I'll get sidetracked and I won't end up doing what I came to do. I won't accomplish my goals or my objectives after my time is up in the gym. And it hit me. It really kind of just began to make me think about life. And we're all given a specific amount of time. And if I had just walked into that gym and spent my entire workout walking around and looking at everything, maybe I was watching a game or just watching everyone else and see what they're doing, I probably wouldn't have accomplished much at all. I would have left the gym having accomplished nothing that I set out to do when I walked in. Life works the same way. And it's easy to get distracted by someone else's pace, maybe by their success. Maybe we look at someone else's circumstances and we compare our careers, we compare our families, maybe we compare our finances. We may even compare our vacations. And golly, have you ever been guilty of comparing social medias? If you're not careful, you're comparing someone else's highlight reel to your real life. And as a result, you'll start running someone else's race. The truth is, you were given this life that you were given and not theirs. You were not given their life. God has a purpose for you. He has a journey for you. He has gifts for you. And yes, he has challenges for you. And those challenges are designed to help you grow into exactly what you were supposed to be. It only distracts you from your destiny when you become fixated and focused on others. You miss what you were meant to be. So this week, I want you to, along with myself, we're going to challenge one another. I want you to keep your eyes on your own path. I want you to be able to celebrate when others have victories and celebrate others' accomplishments and even get down and help people when they have fallen. But don't measure your life against theirs. Just like at the gym, you'll make the most progress in life when you focus on what you are supposed to be doing in your time that you've been given here. So let's have a wonderful week, and let's remember, the only person that we are supposed to be better than is the person that we were yesterday. And when we can harness that, it's a pretty powerful position to live life in. We begin to be more generous. We begin to be more appreciative. We begin to be more impactful. And together, if we go through this week together with that mindset, I truly think we're going to help make this world a better place to live. And that's our pause for positivity this week. All right, we're going to take a quick break. And when we come back, we're going to discuss a very hot topic in the markets right now. And it's likely something you've heard about. It's SpaceX. We're going to discuss what I think is going to take place over the coming weeks, months, maybe even years. And we're going to help you understand a little bit more about how SpaceX has been valued and why I think that even if you're a long-term investor, you should be cautious of participating too heavily in a name like this. Don't go anywhere. We're coming back with more Retirement Matters right after this.
You're listening to the Retirement Matters Show with Dale Smothers. Dale is the founder and president of RD Smothers Wealth Management. We specialize in building retirement plans that allow you to walk away from the worry of running out of money. If you'd like to chat with a member of our team, you can do so absolutely free by calling 270-600-PLAN. That's 270-600-PLAN. Visit us online at rdswealth.com and be sure to sign up for our free weekly newsletter.
All right, welcome back to the show. Let's get into this hot topic in the market, SpaceX. Now, you may have heard of this company in the past, and they do a lot more than just send rockets to space. Although I read a statistic the other day that they are responsible for more space tonnage, which is a fancy word for things that are sent to space. They're responsible for more as a single company than every other space company combined, including NASA. More things go up into space by SpaceX rockets than anything else in the world today. And that's a pretty staggering statistic, especially when you think about who runs the company, SpaceX. Now, I'm sure you're aware, but Elon Musk, also the owner and founder of Tesla, this particular company, SpaceX, has recently surpassed large corporations, very large corporations, in what we call market capitalization. Now, that's just a fancy way for saying how big is the company. And the way they define that is by taking every stock that is outstanding. So if you have, let's say, 10 stocks, and you multiply it by the dollar per share. So if 10 stocks were worth $100 a share, then this particular company's market cap would be $1,000. However, SpaceX is a $2 trillion valuation as of this weekend. And at its high, right after the IPO, the initial public offering, it was nearly $3 trillion stock. Again, surpassing companies like Amazon for the size of this company. And you may think, wow, that's huge. Clearly, this company is going to be a revolutionary company. And I'm not here to debate whether or not this is a good company, but I am going to help you understand why paying such a high valuation for a company that makes very little money may be very similar to going into the casino, putting all of your chips on red and spinning the wheel. I hate to rain on anyone's parade. If you've bought SpaceX and you're in it for the long haul, I don't necessarily think you're going to be disappointed if you will hold that stock for several years. But in the short term, I would urge you not to sell out when the stock falls. And it's very, very likely that it will fall from where it is today. This weekend, it traded just under its IPO briefly and ended up closing just at its IPO, the initial public offering price. It came to market at $150 a share. Very briefly, it was $149. It looks like on Friday, I'm looking at this at $9.55. We could have bought it for $149 a share. It closed the market at $152 a share. I'm not here to necessarily talk about one particular stock as much as I am to talk about why chasing what everyone else deems to be good is not always good for you. And we'll use SpaceX as an example. One way to think about SpaceX and its valuation is to compare it to how much it makes or revenue every year versus how expensive it is. And if you were to take a company like Amazon, let's say, and you were to see how it is priced in the market compared to its stock price, what are its sales for the year or its revenue for the year? There's actually a ratio called revenue to price, and sometimes it'll be called sales to price. And when you look at a sales to price ratio for, let's say, a company like Amazon, you get a number 3.5. What does that tell us? Well, in layman's terms, what that means is when you invest in a company like Amazon at its current price, you would need Amazon to generate the same amount of revenue it's generating today for 3.5 years to essentially get back the money that you bought it for, or to earn, let's say, to make the money that you bought it for. I'm going to put this into a easier way to understand. Let's just imagine that a lemonade stand. No, let's make it a bakery. Okay, there's a bakery down the road that you want to purchase. You get to looking at its books, and you realize this bakery has $100,000 worth of sales in a year. This is not profit, it's just sales. And the company is on sale right now. It's being sold for $350,000. That would be like purchasing Amazon. And we all know that if you buy a share of a company, you only purchase a small portion of it. But that's essentially how Amazon is valued, as if it were a bakery that sold $100,000 a year worth of baked goods, and it's priced at $350,000 market cap, right? Let's take SpaceX and compare that. And again, I want to remind you that recently SpaceX surpassed Amazon in its market cap, meaning that investors right now are willing to say that it's a bigger company generating more sales, more profit, more earnings than a company like Amazon. But when you look at the numbers, it's not even close. It would actually break down to be this. Remember, Amazon right now is selling for 3.5 times its annual revenue, a share of Amazon. Okay. A share of SpaceX, depending on what number you're using with its revenue, is selling for somewhere around 100 to 110 times its annual revenue. Now, I understand that SpaceX is going to have revolutionary breakthroughs. I understand that SpaceX is going to do big things. But SpaceX has been around for 24 years. And to think that it's going to do something so big, so revolutionary, that it all of a sudden becomes anywhere close to comparable in 3 to 10 times sales proportion is mind-boggling to me. When you analyze this, put a different way, it's almost like saying that if you buy a share of SpaceX right now, you would need to hold it for 110 years for it to generate in its current revenue the amount of money that you put into it. Let's say it a different way. Let's call it the bakery. You know, the bakery that we just talked about that we equated to Amazon, priced the same way as Amazon. The bakery had $100,000 a year of revenue, and it was out to the public for sale at $350,000. If we were pricing it like SpaceX, we would actually be saying that same bakery that makes $100,000 worth of revenue is on sale for $10 to $11 million. And we're seeing people pay that price simply because one day it might sell baked goods on Mars. And, you know, it's just challenging for me to see anyone put money into this company at this present time. Am I going to tell you that SpaceX will never be nothing? Absolutely not. But I am going to tell you that I can almost boldly predict SpaceX will be cheaper than it is today. There's a lot of headwinds coming. One in particular is the lockup period for inside buyers. These people who bought it before it came to market, the high net worth, what we call accredited investors, these guys are probably going to take some profit at their current price. I mean, wouldn't you? If you were a previous owner of this bakery that basically sold $100,000 worth of goods, and now someone was willing to offer you a price that would essentially make your share worth $11 million, wouldn't you take that deal? There's going to be a lot of selling coming to the market for SpaceX, and probably for a lot of names just like SpaceX. So be careful as you tread through this market and understand what you are buying and why you're buying it, how it fits into your portfolio, and how long you plan to use it in the market, or until you need to use it, let's say, and how long you plan to let it set and bake, no pun intended. And I'll end this section with this. A lot of times we see people who come in and they have no idea what they own. And I'm not here to tell you that you got to know every little thing that you own, but you do got to understand why you own what you own. And you've got to understand when it is that you will be selling what you own, especially as you enter into retirement income planning phase. We see so many people who have no idea. They've never had an actual income map drawn for them. If that's you, give us a call. We can do this with you. 270-600-PLAN. We can put some real serious attention to where you are and where you want to be and help you build the retirement you've always imagined. We are here to help you do that, and we're one phone call away. 270-600-PLAN. Give us a call today. We'll sit down with you and help you understand what the next steps need to be. All right, we're going to go into the tax discussion, and I know that is everyone's favorite, the Uncle Sam or the IRS portion that you owe on your retirement savings. Is there a way to pay that a little bit quicker, a little more efficiently, and at a lower rate? We believe so for most people. Whether or not it makes sense for you, all really lies inside of your tax plan. We can help you build that. And we're going to talk after this break about why it's important and how to maybe think about the tax code in a totally different way than you ever have before, how we help our clients navigate what we call the retirement tax fountain. Don't go anywhere. We're coming back with more Retirement Matters right after this.
Thank you for listening to Retirement Matters, presented by R.D. Smothers Wealth Management. If you'd like to speak with us, give us a call at 270-600-PLAN. And if you enjoy the information in this show and would like to hear more, you can access previous shows by searching for the Retirement Matters podcast on the podcast platform of your choice. We also produce a weekly newsletter. Receive it free to your email inbox by signing up online at rdswealth.com.
All right, welcome back to the show. Let's get into this retirement tax fountain and what it means for you. I need you to know that if you're over the age of 59 and a half, or especially if you're over the age of 60, you need to be doing some things right now over the next 3 years to diagnose your current tax situation and make sure you do not have a tax tumor growing in your retirement account. All of this must be done around your income plan, taking a real quick look at your investment plan, doing a deep dive on your tax plan. Make sure that you are on board for paying out the IRS as quickly and as efficiently as possible. We do this by understanding the tax code first. And to do that, we like to equate the tax code to a fountain, a tax fountain to be specific. And I want you to first picture that you are pouring every dollar you make in a given year into this giant fountain. Now, if you can imagine that for a moment, I want you to think about the dollars that you put in as liquid, and as they pour into this fountain with a small bucket, we'll use that terminology at the top, a little bit larger bucket below, a little bit larger bucket below that one, and so on. You are pouring this into the top, and it's filling up the small bucket, spilling to the next, and then spilling to the next. If you can imagine that with me, I want you to now think about that first bucket as something we would call the deduction bucket. The second bucket is a 10% bucket. The next bucket is a 12%. The following bucket is 22, and then 24, and so on. And what we have just designed in your mind is how the tax code works. At the end of every year, the IRS requires you to pay taxes on the money that you made the year prior, and you have an obligation to explain to them how much your taxes were. And in order to do that, a lot of times maybe we'll hire a CPA or a tax preparer to put together a tax return. And this is kind of how this works. All of the income that you have put in first fills up what we would call the standard deduction. Now, depending on your age, 65 in particular, you have bonus deductions. Depending on if you own businesses, you may have extra deductions. And instead of standard deduction, you would do an itemized deduction. But for the average American, it's a standard deduction that gets filled up. And then from there, it spills over into the 10% tax bracket. Everything that falls in that bucket in your fountain is now taxed at 10%. But it only holds a small amount. From there, it spills over into the 12%. And everything in that bucket is taxed at 12%. And what we oftentimes find is that people are filling up a little bit of their 22% bucket. But when we look at it from this perspective, we realize there's still plenty of room to keep pouring and fill up that 22% tax bracket or bucket in this analogy with additional income. And you may think, well, why would I ever want to do that? And the answer really depends on where you are in your retirement journey. Whether or not you would want to do that is going to be determined by the amount of income you need in retirement. And a lot of times we find out that people are maybe not taking all of the money they need to take at the times they need to take it. Instead, they are waiting until later when they must take it, either by a forced required minimum distribution, which is the worst, or because they just need extra income in that particular year. And for that reason, they're leaving opportunity on the table. The opportunity is to go ahead and take some extra income and pay taxes at a known rate, say 12 or 22%, as opposed to waiting until later and paying it at an unknown rate. Because this tax fountain, it changes every 2 or 3 years. Congress will get together and the tax code changes. We like to say that the tax code is written in pencil, not in pen. And for that reason, paying the taxes that you owe at a known rate of 12, 24, or certainly at 22% makes a lot of sense for a lot of people. This allows you to then move that money that you have pulled out of your traditional IRA or your 401k, putting it into a Roth account that then grows tax deferred and tax free when you need it in the future. Now, I could harp for 20 minutes on why that could be important for some people, not for everyone, but for some. But it doesn't really make sense until you start to put it together in your own plan. And what we find is a lot of times by not doing this, you end up costing yourself much more money in the future by taxing Social Security unnecessarily, taxing Medicare unnecessarily and unexpectedly, or even worse, passing this money on to your kids where then they have to pull it out at a restrictive schedule, not of their own choosing, but by the government's choosing, and then they are taxed at higher rates than you would have been. This is what we would call a legacy destruction vehicle that the government employs. And for you, we can consider it a tax tumor that unfortunately grows in your retirement account undiagnosed for many years until it's too late. When to do something about this is often between the ages of 60 and 63. And the reason for this is because this is the time in which you can do Roth conversions at a fairly large amount if it's designed or desired inside of your plan and not have something called IRMA hit you unaware. IRMA is an extra expense, you can consider it a tax, on Medicare premiums. So again, I'm just talking for 5 or 6 minutes here, and you can start to begin to understand why it's important for all of this to work together. And that's why we preach it almost from the housetops, saying, please do not go into retirement only worried about your investments. It's very important that you are concerned about all of this: Social Security, Medicare, how taxes will impact those things, what income is necessary. And again, by doing this, we believe at RDS Wealth, if we can save you 10, 20, or maybe 30% on your tax bill over your lifetime, which happens very frequently with our clients, We know that by doing that, we have increased essentially the return that you have received, very similar to as if we had made extra 10, 20, or 30% on your investments, but we've taken no added risk to do so. All right, and just like that, we are at the end of the show. I hope that this is starting to paint a picture for you of why it's important for you to really understand your current tax situation and take full advantage of that when the time is right. If you are over the age of 59 and a half, not yet 65, it may be the perfect opportunity for you to begin looking at this Roth conversion strategy. If you're over the age of 65, it can still be done. It just may be something that you need to do in smaller doses. And of how much, well, we can help you determine that. Give our team a call, 270-600-PLAN, or navigate to our website, rdswealth.com. Set up your time to talk today, because waiting too late could cost you dearly in the future. And for those of you who are maybe not yet 60, you're contributing to 401k, consider the Roth option. Make sure that you're not turning a blind eye to what Roth accounts can do for you in your very own retirement journey. All right, that's the show, and I hope that it has been educational. I hope that you found something interesting that you can take back and apply to your own portfolio. And I really hope that in the future we get to talk together in person. But until we talk again, always remember, save money, plan well, and live happy in retirement. God bless.
Investing involves a risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual situation. R.D. Smothers Wealth Management is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by R.D. Smothers Wealth Management.